In this video, traders, I want to talk a little bit about from idea to trade, the process to go through to generate that trade idea. Stick around. Hey guys, well, welcome to you. Thank you so much for joining me. All right, so I think many of us have made the mistake that we just stop at number one. And number one here is a directional thesis. So we look at a chart and we go, right, what's going to happen? We see this type of thing, we go, whatever the chart is, oh, I think that's a fake out to the high side, I want to get short. And we just have a directional bias, or we think it's a long, whatever it may be, doesn't matter. And we stop there. And if we're not careful, we then dive into the trade, right? We take the trade, don't think any more about it. We take a trade, and often we're thinking, I really regret taking that trade. I really shouldn't have taken that trade. I'm in the trade now, it's pulled back. And just imagine that you're in this situation, and we've all been here, right? We've all been in this situation. You look at a chart, you go, I need to get long on this, I need to get long. So, okay, you buy at this point here, then the market kind of comes back down here, and then you're in a situation where you go, well, what do I do now? Because I mean, this support's going to hold, right? It's support. I'm already underwater, and then it goes a little bit lower and lower, and you go, yeah, but it's just a fake out under support. I really shouldn't have bought at the highs, but you know, what do I do now? And sometimes people add to the position, sometimes, but you're just in this awkward situation, and then eventually either goes your way and you go, yeah, I'm right, and it comes back to here, and you take it out because you just want to relieve the pain. It comes out of break even, or it goes lower. One little spike stops you out and then pings back up and goes in your direction. And that's just because you've had a directional thesis which was correct, but the structure of the trade was incorrect. And as traders, we've got a couple of jobs, right? The first primary job is a directional guess, bet, if you like. Hey, we're going to go higher, we're going to go lower. And you know, that's the primary job, right? Because you can't make money if you get that directional element wrong. Apart from with trading volatility, of course, via options, but let's forget that for now. Imagine just making a directional bet, and that's how traders make money. If you're wrong on that, you're not going to make money. That's simply put. So you have to get that right to a certain degree. The order of magnitude you get it right, and how much size you put on determine how much profit you make from it. But I think we're all agreed you've got to make that bet. So directional thesis one. So let's say we had that directional thesis and we said, okay, I think this is long, and you go through a process to double check that and make sure, hey, am I got my higher time frames? And you know this type of structure, guys. We know the process. Let's check the higher time frames. Let's check if there's any data coming out. Let's check the range on the day if we're trading intraday. Let's check the position of this, that, whatever it may be. You go through that process and you say, hey, yeah, that's a good chance that could continue higher. Fine. Then we go on to number two, which is the entry criteria. And this is, again, some traders do this, but a lot of traders just do that. And some traders go, okay, now I think this is where you can really add, a lot of power to the trade, because, stopping there, fine, a lot of people do that. This now brings you're sort of playing a game of chess, right? You're forward thinking a bit. And imagine if that price was just there as we saw, and you say, okay, I think we're going long. And then you could do your analysis and go through the checklist on that. Fine. Number two, now what's my entry criteria for this? And this is where you come up with different ideas and themes, right? So you go, okay, on my first idea is, hey, if we pull back to this support level here, that's a good buy for me. If we rally, flag at highs, I'd take that buy there. If we come back, maybe fake out through this low here and dip back up, I'd buy that. So I'm just taking this off the top of my head, all I think valid ways to get in, but there's three structured ways to enter the trade. And the difference with that is you can now, you're building the plan, right? You've got your directional thesis, and now you're saying, hey, how can I structure an entry to this? You've got, okay, let's imagine you've got, if we imagine this was the pattern here, so we've got coming back to support and going up, and so that was kind of one. And then we've got two, which is the kind of rally and flag and go, and then three, which is the kind of fake out to the downside and then maybe go. I know it's a bit rough, but you kind of get the idea. You come up with these ideas and structures. You can obviously do it much cleaner than messing around on a whiteboard with a marker pen, but you have this structure and criteria. Now you say, right, I've got some ideas of how I might get into this trade. What's a feasible target? And the reason I say feasible target is because we don't want to fall into the trap of saying, I think it's going to go 500 points. Maybe. Is that feasible? I don't know. You've got to look and say, hey, what's the daily ATR of the day or the week or whatever time frame we're trading? What's the time frame looking to hold this position for? All this type of stuff. If you're expecting the market to rally, one day's ATR in 5 minutes, you're going to be disappointed. You could do it, but the chance of doing it one in wherever it is the mathematicians options will tell you ridiculous amount. Like once every 3 years it might do that. So you need to then go, okay, what's a realistic target? So now we're adding layers and strategies, and you might then knock some of these ideas off because you go, actually, I don't want to take that high flag because that's really close to the target. My target's only kind of a little bit higher. I'm expecting like a final burst. So actually, I'm going to take that off my list. And this may be, but it depends how, yeah, I could probably get in on that. So I'm left with like 2 now. I've got directional thesis, the buy side. I've got my entry criteria, which is a pullback to the breakout point or a little dip below this low, and then a buy there. Okay, I'm building stuff, and I've discarded the flag, valid, but my target isn't so far up that might not be feasible to take. Fine. Now I go for number 4. Is my sensible stop placement. So now I look and I'm building this structure and I say, what's my sensible stop placement? Okay, if I took this trade, which is the pullback to here, and let's clear this a little bit. I know this is a bit mucky, but you get what I'm talking about, guys, I'm sure. You imagine now you come back to that breakout point. That's your idea. You're here at the moment, but you're thinking it comes back to here. You're like, oh, where can that stop be? You're like, oh, you know what? It probably could come into here. Yeah, maybe I need a bit. You start to think, okay, well, right, let me come back to that. What about this one, number 3, which is where we come lower in this situation, fake under that low and come back. Now, okay, in this situation, the stop can be a little bit quantified, right? I can put a stop here, and my target up here gives me decent risk reward structure. It's an okay place for a stop. If it does that and it goes back lower, I really don't want the trade. So, okay, we're going through a process. You might say, I'm not going to take just a pull back to there. I want that or nothing. So now you've got your directional bias, you've got your entry criteria, and you've decided on a sensible stop placement. And you might still consider that. I'm not saying you wouldn't, but you're going through this process and saying, hey, okay, there's 2 ideas here. But just for kind of example purposes, we're coming down with for 1 idea and theme. There's my stop placement, there's this. And then you go, okay, what's my risk allocation? That's a very simple sum based on how much you're prepared to risk on this deal. What are you prepared to risk on this? $500, $1,000, $2,000, $100, whatever it is. And you go, okay, well, that's the size I need. If it goes through there, what sort of allocation do I need? How much cushion do I need to give it when it comes back through there? How far will it go through? All right, I've got a rough idea of the size. I've got a rough idea of the risk reward on the play. I've got a rough idea I'm going to add to the position here or take some of the position off. You can plan the trade, and you see how this is so much more advanced. And you know, whilst we're not trying to be overcomplicating things here, we're still simply going through this kind of flow chart, but we have much more structure to the trade and stuff. We're saying, okay, we've got directional thesis, we've got the entry criteria, we've got a feasible target, sensible stop placement, risk allocation. Now, you know, in this example, I've kind of just taken off those, but you more than likely going to get a situation where you have maybe 3 ideas. And they're all directional plays, like, hey, I'd buy this on a pullback to here. I'd buy this on a flag that pauses. Yes, it's a higher price, but it doesn't matter. And I buy it when it did this. So you've got these ideas. This is where I put my stop in this case, in this case, in this case. This is how I'd structure each of these deals. This is my risk allocation. And you're so much more prepared mentally. That is so much more effective than anything else. And you might say, yeah, but these things might not happen. Of course they might not. Of course something different can happen. But you know, you're trying to preempt all of the potential ways and structures and ways that you want to get in. You know, this is the key thing about trading. It's not just directional, being correct on direction, it's being correct on your entry, not getting stopped out along the way. It's all very well saying, oh, I think the market's going higher, but if it goes down by 1,000 points first before it goes up 10, you're right, but you know, there's not trade, right? There's no trade there. It's not feasible. Now, one, you probably wouldn't be able to sit through a 1,000-point drawdown. Number 2, it's not sustainable because the risk reward is just skewed, and you know why. It just doesn't make any sense. So we have to have, you know, some structure behind the trade as well. So I think this kind of process or a similar framework is a good way to approach things. Your directional thesis, your entry criteria, a feasible target if you have one, and that could also be just on my trail, it's fine. A sensible stop placement, and then a risk allocation based on all that structure. And then you have maybe 3 or 4 ideas, maybe you have more, depending on the quality of the trade and your how much emphasis or how much belief you've got in direction. I mean, if you've got a high conviction rate on the directional play, you might come up with grade A's, grade B's, and grade C's to get into it. But what you're not doing is you're not just buying it and saying it's going up. Because you're thinking clearly about, okay, maybe I'm thinking it goes from A to B, but it could go down first, it could oscillate first, it could do this. How can I really maximize being correct, maximize my correctness, for want of a better word? Because that's what we're trying to do, right? Trying to make as much money as possible with the least amount of risk possible. And if we can fine tune that entry without overcomplicating it, without trying to be too clever, but structuring some of these ideas and entry criteria and flexible targets and stock placements, then we're in a much better position. And from a confidence perspective too, final thing guys, confidence perspective too, this is a different world, because you feel like you are empowered, you're on the front foot, you are taking your trading to the market. You're saying, okay, I need you to do this before I'm going to get involved. I'm just not going to go ooh and get all excited just because you're going higher. It's like, okay, that's fine. I still think you might go from A to B. And if you go from A to B without doing all these things, fine. And if that happens over time, you might have to readjust how you analyze things, but that's okay. I'm prepared to miss it. It either does what I want it to do or it doesn't, or I don't get involved in the trade. And just build your confidence and says, I'm not a slave to the market. I don't just jump when it goes higher and dips low, whatever it may be. I think carefully. I play the game of chess. I try to forward think exactly how the market could get to that final target that I predict and how I can best express that trade and make the most amount of money possible for the least amount of risk. Keep your risk managed. Whatever you do, I shall see you in the next one. Bye-bye.